A pip. Another important concept in the Forex market is the pip. Pip, singular, or pips, plural. In the Forex market, the exchange rate rises by pips and falls by pips. For most of the currencies, the pips are denoted 4 places after the decimal point. In other words, if the euro-dollar rate is 1.5220, then the number of the pip is 0. If the exchange rate was previously 1.5220 and now it rose by 1 pip, the exchange rate will be 1.5221. If the exchange rate fell by 10 pips, it would be 1.5210, and so on. The Japanese yen is different. For the Japanese yen, the pip is denoted at 2 places after the decimal point, meaning that if the US dollar Japanese yen is 88.57, then the pip is equal to 7. If the exchange rate rises by 3 pips, it will be equal to 88.60. And if it decreases by 27 pips, the exchange rate would be 88.30. Short. This term refers to a sale trade. The term short is used because when you sell, you have less of the sold asset. Going short means entering a sale trade in which you sell an asset. Long. This term refers to buying a trade. Long comes from belong, as in belongs to me. Going long means entering a buy trade in which you buy an asset. Take profit order. A take profit order is intended for a scenario in which a transaction is profitable and the changes in the exchange rate are reflecting increased profits. If a client is not interested in constantly following the transaction, but is rather interested in getting out of the market at a predetermined profit, all the client has to do is place a take profit at an exchange rate which is higher than the purchase rate, or rather, determine a monetary amount at which he or she would like to exit the transaction. For example, we've bought euros at a particular exchange rate and we placed a take profit order at 100 pips above the exchange rate of purchase. We know that in this specific transaction, we can only profit a maximum of 100 pips. These two orders do not entail any payment of commission. They can be placed at the beginning of the transaction, be changed in the course of the exchange, be moved or removed as long as they haven't been executed yet. It's important to note that there are brokers who allow you to place the order only after the transaction has been opened. On the other hand, there are brokers who allow you to place these orders at the beginning of the transaction. It's all subject to different firm policies. First, let's explain what a trend is. Well, a trend is a combination of waves that create the market's direction. Trends do not move in a linear downwards or upwards direction. Rather, they are hidden between the lines of the chart, requiring us to identify them on our own. There are 3 possible directions a chart can move in: up, down, and sideways. We identify a trend using peaks and troughs. The foundation of technical analysis rests on identifying support and resistance levels. Support and resistance are like a floor and ceiling that restrict the price movement from above and below. A support level is a price level at which the asset tends to stop moving downwards and then reverses direction and starts moving back up. The support level is represented in the diagram by a horizontal or near horizontal line that connects several troughs. The more troughs on the same price level, the stronger the support level. Usually, when a breakout of a strong support level occurs, the trend reversal can be expected, with the price continuing to move in the direction of the new trend. A resistance level is a price level at which the asset tends to stop moving upwards and then reverses direction and starts moving back down. The resistance level is represented in the diagram by a horizontal or near horizontal line that connects several peaks. The more peaks on the same price level, the stronger the resistance level. The stronger the resistance level, the stronger the breakout will likely be when the price eventually does break through the resistance line. The start of a breakout is an excellent point to enter a trade.